Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group. And today I'm coming to you with our last market insight for 2024. It's been a fantastic year for the markets, with the stock market hitting new all-time highs over 6,000. But as we know, investing isn't a decision that's made in the rearview mirror. We need to look ahead to 2025 and try to get an assessment of what we should expect as we enter the new year. We'll begin by taking a look at stocks. It's been a tremendous run so far in 2024, and there's good reason to think that the upside markets could continue into 2025. There's a number of fundamental factors that support the markets. The U.S. economy continues to be strong, overcoming those lingering concerns about the potential for a recession. The outlook for corporate profits is also robust. Current forecasts have corporate earnings growing at a double-digit rate in the coming year, which is typically a key for higher stock prices in the year ahead. Now, one of the things that we need to be prepared for as we go into 2025 is the potential for a short-term correction. The stock market has been flying all through 2024, trading well above its historical trend lines. It's important to remember that the laws of gravity have not been repealed on this earth, and they haven't been repealed for financial markets either. And stocks have historically found their way back to these trend lines over time. So we could see a correction anywhere between 3% to 18% on the S&P 500 over a 4 to 12 week period, some point in 2025, and the uptrend in stocks would still be intact. The bull market would still be alive, even with an 18% correction in stocks. And that's an important key to keep in mind as we go through 2025. The fundamental backdrop is strong, but markets never go up in a straight line. There's always pullbacks. And instead of looking at those pullbacks with concern, we want to see them with opportunity. Now, what's the primary downside risk for stocks as we go into 2025? It's the same thing that dogged them into 2022, and it's something we're going to want to keep a close eye on as we go not only through 2025, but through the remainder of the decade. And that's a renewed rise in inflationary pressures. Since the financial crisis, investors have been so focused on the threat of another financial crisis, which is deflationary or disinflationary, which is another way of saying that prices aren't going up a whole lot, if not going down at a given point in time. That's bad for markets. But what's also bad for markets is if prices go up too much. We saw this in 2021 and 2022, and that helped explain why the S&P fell so much from January to October of that year. Now, inflationary pressures have been coming down through 2023 and 2024, which is a great sign. And all signals suggest that they're going to continue to come down in early 2025. But we got to watch this closely. Now, this renewed rise in inflation is something that we need to keep an eye on, not only for stocks, but also across our asset allocation strategies. This is particularly important for the bond market. We have had a 40-year bull market in bonds. It started in 1981, which was the last time we had a really big inflation problem, and continued all the way through to 2022, which was the most recent renewed rise in inflation since the early 1980s. Now, the bull market in bonds is over, and it was a phenomenal run. And the bond market has stabilized here in recent years. But as inflationary pressures have continued to linger on the economy, so too has that led to middling performance in the bond market. The risks are now more tilted to a potential renewed rise in inflation. And this is for a number of factors. We're seeing a trend towards disglobalization, if not deglobalization, with more and more countries moving to spheres of influence and closing off their borders. We're also hearing more talk about tariffs, not only from the US, but from a variety of other countries around the world. We saw supply chain disruptions during COVID, and the potential continues to exist for further supply chain disruptions given the movement across the world to become more isolated. And lastly, if we're bringing more production onshore to the United States, which has a tremendous amount of merit in terms of economic growth and also national defense, it also leads to higher prices more often than not. All of these factors are inflationary. And one of the things to remember about the bond market is the more inflation we have, the less bonds like it. Now, that doesn't mean that we need to abandon our bond allocations. One of the ways that we manage inflation on the fixed income side is to do what's known as shortening duration. Instead of owning bonds that are going to mature in 10, 20, or 30 years, focusing more on bonds that are going to mature in 1, 2, or 3 years. Why? If the Federal Reserve has to raise interest rates to fight an inflation problem, that means they're going to pay you more today in interest for owning those bonds that are going to mature sooner rather than later. And it also is a great way to protect against the price volatility that can hit the bond market and defend your bond market value. We've talked about stocks, we've talked about bonds. Let's talk about some of the more alternative asset classes as we head into 2025. With the potential risks tilting more towards a renewed outbreak of inflation, that also influences proper allocations on the alternative side. What does that look like? It leads to a focus on categories like real assets or precious metals. Those areas of the market that will see their prices rise along with a rise in inflation. And they also have a low correlation to both stocks and bonds. These are some of the elements to think about in terms of rounding out an asset allocation. We've been through a variety of market environments over the last many decades. We've had a lot of upside, but we've also had our challenging periods too. But look at where we are today at the end of 2024 versus 10 years ago, 20 years ago, 30 years ago or more. We've made tremendous progress in terms of economic growth and increases in stock market and bond market values. And there's no reason to think that that prosperity won't continue into the future. We'll see short-term volatility along the way, but the most important element to consider, whether we're going into 2025, the 2030s, or beyond, is to stick to your long-term discipline. If you've properly built your asset allocation, it's prepared for all different market environments. And there's no reason to think that those principles are going to change as we go through the second half of the decade. This is my last market insight for 2024. So I'd like to take this opportunity to thank you, my audience, for sitting in with me over the past year and talking about the economy, the markets, and the opportunities that are available to us as investors. I hope you have a happy holiday and a happy new year, and I look forward to joining again with you in 2025 as we go through what is bound to be another interesting year. Thanks for joining me for this latest market insight, and I look forward to seeing you again soon.